Can we start? Sure. Okay. Thank you everyone for joining us today for the ICRA Analytics webinar on models under the microscope, navigating the new regulatory frontier. Today, I'm pleased to introduce our esteemed speakers, Mr. Durgesh Jaiswal, Vice President of Risk Management Services at ICRA Analytics. Along with him, Mr. Saurav Kanti Das, Assistant Vice President of Risk Management Services, and Ms. Niharika Gupta, Manager of Risk Management Services at ICRA Analytics. Unfortunately, Mr. Durgesh is feeling a bit under the weather today. So on his behalf, Mr. Saurav will step in and he will be joined by Ms. Niharika. So this webinar includes a concise presentation followed by a Q&A session where we will encourage all of you to participate and share your questions in the Q&A box. At the end of the presentation, we will pick each one of them to answer. So with this note, I'll hand over the space to Mr. Saurav. Saurav, over to you.
Thank you, Shubhasree. Good evening, everyone. Thank you for joining us today. On behalf of ICRA Analytics Limited, I welcome all participants to this session on models under microscope, navigating the new regulatory frontier. In today's financial ecosystem, models sit at the center of critical decision making, from customer evaluation and underwriting depth to early warning indicators, collections, forecasting, and capital planning. The increased dependence on models across these areas requires stronger governance, transparency, and structured oversight. As a delivery lead of risk management services at ICRA Analytics, I see institutions shifting their focus from model development alone to broader framework of validation, monitoring, and lifecycle governance. This transition is essential to ensure reliability, accountability, and alignment with supervisory expectations. Our objective today is to provide a clear, practical, and comprehensive understanding of model governance and validation. I'm joined by Niharika, who leads our model risk and validation practice. Hi, Niharika.
Hi, Saurav.
She will take us through the technical depth and structured assessment approaches and strategic insights drawn across traditional and advanced analytics models, covering wholesale and the retail credit, data science, behavioral, and the application scorecards, business rules engines, and the expected credit loss frameworks as well. Yes, Niharika, hi.
Yeah, thank you, Saurav, and thank you everyone for joining in to ICRA Analytics webinar on model risk management. I look forward to sharing insights from ubiquitous gaps we've observed in the banking and financial services industry, guidance we have received from global and domestic regulatory frameworks, on-ground validation experience with Indian lenders, which may be banks, NBFCs, and fintechs, and helping the institutions to understand how a structured model risk management can actually strengthen reliability and improve decision consistency. Today, our session will cover the concept of model risk, the elements of a model risk management framework, common gaps observed across institutions, global and Indian regulatory expectations, governance perspective and validation perspective across traditional and data science models, strategic benefits that are offered by model validation and model monitoring, business insights that we've been able to impart through our model validation mandates, and future outlook and recommendations for the sector.
So with this structure in place, let us begin with the fundamentals that underpin all model governance discussions. To set the strategic context, it is important to view model risk not just as a technical construct, but as an enterprise level risk that influences decision confidence across multiple business functions. Erika, could you please outline its core meaning?
Certainly, Saurav. Model risk actually refers to the possibility that a model output results in decisions which are deviated from the intended outcomes. So this can happen because the model design has a certain flaw, or there are certain data limitations, or there are some implementation inconsistencies, or usage practice is not in alignment with the intended purpose. Also, with the advent of machine learning models and AI-driven techniques, it is all the more important that institutions understand that a model behavior has to be transparent, it has to be explainable, and it has to align with policy and risk appetite.
That's well articulated. Now, understanding the model risk helps institutions determine where to invest in governance, whether in development, discipline, data quality, independent validation strength, or the monitoring structures. Now, in order to make it very interactive, so it's a poll time. Would like to hear back from you. So, poll on screen, please. This is the poll number 1. So we'll stay in the screen for next 30 seconds. I would request you to give your comments and the opinions on this. Then we'll get to see the results post 30 seconds. So now to see the results, I think, yes, some more is coming up. So let us just wait for a few more seconds. Poll results on screen, please. Yeah. So what we see that the monitoring controls that a particular option has gained 47% out of everything else, and the next is the validation process that is gaining 42% out of the entire, and the documentation standard and policy framework both 5% each. Thank you very much for sharing your opinions. Then please end the poll. So let us now look at the MRM structure, which forms the foundation of any effective model governance environment.
If we can go to the next slide, please, where we see that model risk management is actually a life cycle based framework which comprises of development governance, independent validation, documentation and version control, ongoing monitoring and backtesting, change management, and periodic review and decommissioning. As a framework, this ensures that models operate within controlled boundaries and they remain fit for purpose across time.
So that means lifecycle driven this MRM framework ensures consistency across all model families and functions, strengthening the reliability and the decision assurance. Next slide, please. So based on our experience of working with industry models, what are some most common pitfalls institutions face in the model risk management? Next slide, please.
Yes, sir. I would want to highlight that there have been certain prevalent industry gaps which we have observed while working with several lenders of different size and stature and different regulatory licenses. So these observations can be identified and grouped together into certain defined categories where we see that data limitation and access to homogeneous data actually is one of the biggest problems which the industry today is facing, where we see that many models are currently being built only on stable credit cycles, which actually leads us to a situation that we are not really capturing any unexpected black swan events, and we're not really able to test how the model will behave if a certain unexpected shock is induced because of the real world application. So that limitation on availability of data across different economic cycles and representation challenges across different borrower segments, it actually becomes one of the major gaps or a challenge which the entire industry is facing. Another big challenge will be that sometimes the models designed are really very complicated or they are actually trying to overfit relationships, very granular relationships between detailed variables. So while this actually helps us to capture every tiny relationship between the multiple variables, but it actually makes it more difficult to explain, these kind of granularity when the model is actually working on live deployments. So it's actually suggested that the variables get grouped together on homogeneous bucketing, and if the model is working consistently across different time periods, that kind of assessment has to be put in place. We also see certain challenges with regards to governance processes and practices across the industry. I mean, while certain big banks will have very rigorous governance frameworks and a set of practices and very well established governance policies in which they want their risk management committees and their credit teams to function. But the other players, which may be your small, medium banks or your ever evolving, your NBFCs and fintechs, we see a lot of governance challenges. Sometimes even the model inventory is not completed. These are real time challenges which we are, as validators, we are seeing across the industry. It is also coming to notice that practices on fairness, on ethical considerations, and an explainability nature or characteristic of model, sometimes they get missed out. All the more now that we are transitioning towards adopting ML models, we are seeing that certain institutions fail to explain their model development on these principles of fairness and ethical considerations and explainability. So those, they tend to offer unintentional bias in the model framework. And also there's a big limitation with regards to independence being offered to model validation as an independent practice, completely unrelated to the model development area of these lending institutions. So we are seeing a lot of overlaps happening. Who the modeling team is same as the validating team, and these kind of overlaps are actually hindering the robustness of a structured MRM framework.
So far, these observations highlight areas where enhancements create measurable benefits from model governance and also for the model risk mitigation. Next slide, please. So, our experience is not too deviated from how lenders across the globe are implementing model governance and the roadblocks perceived by them when it comes to effective model risk management framework execution.
Yeah, absolutely, Saurav. So there's a organization body by the name of Risk Management Association, popularly known as RMA, which conducts its survey on model risk management execution and performs a reality check on global players, that where we are in terms of MRM practices, the kind of challenges or constraints these global banks or NBFCs, the lenders, they may be facing, and how the regulator is stepping up to help them mitigate these challenges. So the insights we draw from the findings of the survey, which was actually performed at a global level, is actually very similar to the kind of challenges we've just discussed, what we have seen while our execution with the Indian players as well. So similar type of challenges like roadblocks on cost, on availability of talent, expertise. It's a very niche skill set on performing those kind of quantitative testing. All of that, it actually comes at a cost, and it requires some very niche skill sets. So there's some paucity, with regards to those aspects. While technology is mostly being taken care of, with the availability of so many different technological platforms, we are moving to having a structured platform where model risk management can be conducted and offered as a platform-based tool. So we are progressing there. In terms of independence of operations, most of these models and the model development is seem to be ring fenced, which means that they largely enjoy independent execution and operations at the global bank level. However, there is a we still have a long way to go there when it comes to our own domestic setup. In terms of reporting lines, most of these model risk management teams are reporting to senior officials. Sometimes it would be a CRO or a head ERM or probably a head ORM, which actually ensures a lot of accountability, which is also a regulatory requirement. You know, when you look at feed, accountability is one of the regulatory requirements. So it is largely getting met. However, one big area of concern where everybody needs to draw some attention is on the frequency of validation, where we are seeing that not even even with the top tier risk models, the ones which are highly material, lot of exposure is tied up, big exposure. I mean, big clients are getting passed through those models. Even such models, we are not seeing annual validation cycles across the industry. I mean, some big players are performing annual cycles, but largely it is not there. So that is a big area of concern, which is also in a way overlapping with how within India our regulator is also viewing that annual frequency or an annual frequency of validation is not currently being maintained, but it has been asked given the recent regulation. So we'll speak more on that.
So that means while governance structures are robust, periodic validation and resource investment are areas that require continued focus to strengthen the model risk management framework. Next slide. Now let's start by looking at how regulators respond to common pitfalls in model risk management. The first element is approval. Every model, whether traditional or advanced, requires formal endorsement by the boards, the risk management committee, the RMCs. This ensures accountability at the highest level.
Absolutely. As far as regulatory approval is concerned, after that, we also need to ensure that model validation standards are also being adhered to. So all these regulators, you know, whether we look into the global regulations or the Indian regulations, we'll be having a more deep dive into these regulations in the later stages. But all throughout, we will see lot of convergence that set rigorous checks on model accuracy, model predictability, model stability. All of them have been laid, and it is very important that we are actually meeting the regulators' expectations across all model methodologies.
And finally, we have the responsible regulation. It's not about just the compliance. It's about fairness and transparency. And also, the oversight mechanisms now include fairness metrics and the responsible governance to ensure models are unbiased and explainable. However, let's go back one step to understand exactly what caused the industry to ponder on effective model risk management. Niharika, could you please share some, say, the notable examples of model failures and the lessons they offer?
Absolutely, Saurav. So we've seen several instances of how the industry or everybody here we will perceive that it is just one model making some erroneous outputs, but there's actually a big deal about a model making an erroneous outputs. We've seen that in the 2008 subprime crisis, where flawed assumptions have actually led to widespread financial distress. Even within India, we've seen that models were not able to adequately capture risk at the group level of the lending institution. And then that actually, eroded a lot of profits from an infrastructure finance company. If we also look at a housing finance sector, we've seen a lot of companies have come under regulatory probe because they're actually overestimating their asset quality, and model is nowhere picking it up. Model is not tying it to the borrower's financial creditworthiness and the asset quality matrix being reported by the lending organization. So because of this disconnect, it is not getting reported. However, the system has come under a shock. Also, some mid-sized private banks in India, we've recently seen they have recorded certain spikes in their asset deterioration matrix only because models actually did not result in more accurate output than what it should have been. Some fintechs are also facing challenges where availability of data is very, very thin and it is very heterogeneous. And so the models really don't become explainable to assess that which risk factor has actually caused the model to come out with a certain defined output. There is no explainability or interpretability around that. And that's why fintechs are also seeing certain headwinds. And also this incident, everybody across the industry, we've seen COVID, how it unfolded as a medical pandemic, but then it also exposed our not so rigorous risk management frameworks where we could see that models have been only trained on good economic cycles and only good economic periods. However, incidents like these kind of pandemics, which are actually interrelated industrial events, we are not really capturing them in our models anywhere. And the model performance ultimately becomes unreliable. So, with all of this in perspective, it actually has led us to a situation that model risk management should be an acceptable and more rigorous form of risk management framework and should be given its due credit what it actually deserves, because it is actually saving us from a lot of losses and potential defaults.
Yeah, we can go to the next slide, please. So far, these case studies make it clear that model risk management must be both comprehensive and adaptive to evolving risks. And at this juncture, it becomes very important to see how the regulatory landscape has evolved over the years. Niharika, it may be very useful to outline the key global regulatory frameworks that have influenced the industry practices. Next slide, please.
Absolutely, Saurav. As we've just discussed some of the important cases where we saw model failures and governance failures, to mitigate all of those risks and to make a stronger future for the lending industry, we have some very comprehensive regulations laid down from global regulators, and then we'll also see how India has responded to all of these regulations. So when we look at global model risk governance, we see that SR 11.7 issued by the US Federal Reserve, that's actually the foundation of model risk governance. This guideline actually laid down that model risk is a governance requirement, and it goes beyond your quantitative discipline and being just quantitative testing. This guideline also highlights that complete model inventories are required, independence of validation is required, and usage has to be tracked and audited. Then we also had some guidelines issued by the Basel Committee, where a very detailed working paper, number 14, which was a guiding principles for sound management of model risk, it was issued, and it is actually the cornerstone for backtesting and benchmarking all your internal rating models. European Banking Authority also issued its guidelines in 2021, which has formalized that internal model approvals, independent review functions, documentation completeness, and supervisory engagement is very important when we look at a structured MRM function in a bank or a lender. While in Singapore, we saw that the Monetary Authority of Singapore has very recently published some principles on FEET, which is, again, I'm going back to the fairness, ethical, your accountability and transparency measures, more to do with our AI and ML driven models. So it's more for your advanced analytics models. And updated guidelines in the similar field on AI models were issued by the Canada's OSFI, which are required to be come into effect in 2027. And all of these frameworks on a collective level, they're actually just converging to the importance of governance consistency and making models more explainable and as a use of evidence for model performance across time.
Next slide, please. Now it is clear that the global direction is consistent. Now coming to India, the Reserve Bank of India's 2024 draft model risk management framework is definitely an important milestone. The draft aligns closely with ISAR 11.7 and the EB expectations and also outlines the need for board-approved MRM policy, comprehensive model inventories, tiering of models based on the materiality, independent validation, then model lifecycle governance, robust documentation and version control, model monitoring and backtesting, and the regular review cycles, to name a few.
Yes, absolutely, Saurav. These guidelines that were the draft guidelines issued by RBI through the circular, which we are already citing the circular on the slide, dated August 5, 2024, and also supplementary guidelines by RBI recently in October 2025 on ECL, but where they're also explicitly mentioning and actually acknowledging model risk management, also one of the risk elements, and giving a certain structure to how banks and NBFCs can adopt a very well rigorous and very well described model risk management practice within the Indian lenders. So yes, RBI, our Indian regulator, is moving in tandem with the regulations.
Thank you, Niyaka. Now it's a poll time. Would like to hear back from you once again. It will be the poll number 2 on screen, please. Poll. We'll stay on the screen for 30 seconds to hear back from you. Then I will get to see the results. Coming in. Thank you very much. Some more would expect. It's coming in. So now we can see the results on screen, please. So far, yes, the automated checks that is coming, gaining 59%, well ahead of the other choices. Then comes the manual review, which is 18%, and the vendor solutions 14%, and no formal process that is coming as 9%. Okay, so this automated checks, that is the winner here. So we can stop sharing the poll and we'll get to the other slides, please.
So yeah, I mean, as we were just discussing, that we can draw some convergence between global regulatory frameworks, which have been there for a considerable period of time, where annual model validation and independent oversight is considered as a standard practice. However, in India, we are just very recently formalizing all of this, but we're still coping up and moving in alignment with the global regulations. And there is also a lot of growing emphasis on how the data science models need to become more explainable, and certain bias checks and additional testing apart from the regular statistical testing, is also gaining more traction even within the Indian markets.
Summing up, the alignment of Indian regulations with the global standards marks a significant step forward for the industry. So we'll move to the next slide, please. So as models diversify, governance must be proportionate to model complexity and usage. Now let's understand the validation perspectives on traditional as well as the data science models. Erika, could you please elaborate on the characteristics of the traditional models, please? Next slide.
Yeah, definitely, Saurav. So, traditional statistical models, as we all understand, are something like your logistic regression models, which help us to estimate PDs. This may be your behavioral or application scorecards, or these may also be your survival models used for prepayment analysis. All of the traditional statistical models, they are relying on well-defined mathematical assumptions. There is explicit understanding of the relationship between variables and the outcomes, which allows the validator to examine conceptual soundness, variable stability, impact of multicollinearity, coefficient directionality, and the business rationale for including these factors as risk parameters in this model framework. When we also look at model validation for a traditional scorecard, or let's say a traditional statistical model, we are trying to understand its discriminatory power, which will involve industry-wide accepted metrics such as Gini, KS, or ROC. This actually helps us to undermine the model's effectiveness at risk ranking. We also conduct certain stability assessments by measuring indicators such as PSI and CSI, which is your population stability index, and your character stability index, where we want to see that if there is a potential drift, or is the underlying borrower population still stable, or have we seen any structural movement across the explainability of the risk parameters and across the borrower's behavior. We also want to do a lot of back testing, of these models, where models output is generated across different time windows, where we want to see that if a certain historical data set would have been ingested, will we still see similar and consistent model outputs or not? And one more important thing is very, very important to understand the sensitivity and stress testing impact of when we expose the model to various economic cycles, and we introduce certain shocks in the macroeconomic variables. Then we want to understand how well the model output has recalibrated itself to encompass the different economic regimes. So all of this actually forms a part of our quantitative validation when we look at traditional models.
So these validation techniques are not just regulatory checkboxes. They are essential for building trust in our models. By combining this discriminative power, calibration, stability, and stress testing with benchmarking comparisons, we can ensure that the industry models are accurate, resilient, and fair.
Right.
Ultimately, the strong validation safeguards decision making and also reinforces the confidence amongst the stakeholders and the regulators alike. So we'll move to the next slide, please. However, after such, this rigorous statistical testing, why would the validator and the regulator insist on performing the qualitative validation on traditional models? I mean,
Yes, it's a very valid question, Saurav, and in fact, it's a very regularly asked question when we interact with our clients. We there is a certain understanding that is required, that while all your statistical tests, which we've seen in the previous slides and in our previous, how we've been discussing so far, all of those tests actually do a technical analysis on the robustness of your models, but there is still a overall structural soundness which we still need to review. And how do we do that? Qualitative validation is the answer, where we are able to understand the usage aspects of the risk parameters. We are able to understand the back-end industry data. There's a lot of industry data that gets consumed when a model gets built. How frequently are we updating that back-end data? Is the data symbolic of the borrower segment? Those kind of scrutiny and data quality checks becomes essential element of a qualitative validation. Also, in qualitative validation, it gives us an opportunity to understand that if an important risk driver is actually missing from the model's framework, Some important risk drivers, something like a climate risk or an ESG risk. It may not really be part of your original model framework, but how to incorporate it and why we should incorporate it. Only the qualitative validation will give you that kind of lens. So it is important to perform even qualitative validation even when we are looking at the traditional models.
Yeah, I agree on this. That definitely adds an important dimension to model assessment, supporting both regulatory and the business goals. Yeah, next slide, please. So now, yes, the ML models, the machine learning models, and that definitely introduce complexities that require deeper oversight. Right, Neha?
Absolutely, Saurav. So these models, popularly we are using XGBoost, we are using random forest, maybe gradient boosting. Some players are using neural networks. For all of these machine learning models, they are just identifying nonlinear relationships and interactions, which is not really visible in a traditional model. So while we need to test these models on the regulatory prescribed statistical test, which we are already doing for traditional models, that assessment has to be made more rigorous because we are also capturing non-linear relationships. So how to test those non-linear, the accuracy and reliability of those non-linear relationships, we need to have some more frameworks and metrics. So probably using a train test split basic approach, your cross validation using k-fold, stratified k-fold. If we have a limited data set, then we enhances using bootstrapping or LOCV, sharp and line values, use of challenger models. So all of these are add-on testing and add-on really testing frameworks that need to be used when we are talking of your ML-based models.
So definitely that provides a very clear distinction from the traditional models, which are structured and highly interpretable. And for this, ML-based models that offer predictive strength but require enhanced governance, explainability mechanisms, and continuous monitoring as well. Now we'll move to the next slide, please. We now shift to the strategic value delivered by validation and monitoring. Nerika, could you please outline the ways in which the model governance encompasses the business decisions?
Absolutely, Saurav. We've been discussing this throughout that there has to be a certain motivation for the CROs and the head of risks
Next slide,
investing so
please.
much
Sorry.
time and resources.
Yeah, go on.
In fact, yeah, investing in so much time and resources on effective model validations. So it is not just a technical soundness, it is not just a governance, compliance. It is beyond that, where we are actually able to derive some important insights which may be underlying. It's already there, but it is not visible to the naked eye. So validation actually helps us to undercover all those insights, where it acts as a early warning signal. Any potential credit deterioration is flagged well in advance. It's just the way of how we are looking at those rating migrations. We need to understand that it is actually going to be resulting in a default or not. So validations will help you do that. It also enables us to understand that the override that we are using in the models, is it applicable only to some specific segments? It is restricted to some specific rating grades. Then there is a sign of caution that the model is probably not giving correct outputs on its own, and a human intervention is required. So why that intervention is required? Do we need to do something on the policy, on the framework? That kind of a eye opener is available. Is the model, or is the institution rather, effectively segmenting its target customers, its target borrowers, and is it capturing the borrower's real time repayment behavioral insights into redesigning its product features? So that is a very interesting insight that a model validation execution can offer. And when we are recalibrating our PDs, when we are recalibrating our LGDs, we are also optimizing our capital. We are also optimizing the provisioning required for future. You make better forecast, so you have better provisioning. And then it definitely does give you that governance assurance that the way we are working with, the way we are rating our borrowers, we are well governed, we are well within the system. So that is another add-on, that can be derived.
So it clearly demonstrates how model risk management contributes directly to portfolio stability, the P&L outcomes, and the strategic planning as well. We'll move to the next slide. Dorika, could you please pinpoint some specific use case indicating the improved business resilience that would be have been offered to clients through validation execution from our desk, ICRA Analytics desk?
Absolutely, Saurav. So,
Right.
our experience ranges from working with banks, NBFCs, fintechs, on traditional wholesale models, on retail scorecards, which may be
It's
application or behavioral.
the slide has not changed. Next slide, please. Yeah.
Yeah, and then so it encompasses traditional wholesale models, your retail scorecards, some specific business rule engines, machine learning models. We at Icra Analytics, we have a very well diversified experience of working with all types of models and all types of clients. And all throughout this execution, we've understood some very important, gaps. I would say probably some shortcomings, which we could highlight, offer as insights, and it has actually resulted in a positive impact in that particular lending organization's overall credit and lending environment. So we've actually been able to do our positive contribution. In one of the cases, we could identify that use of override is limited to certain model type, certain borrower category. So that model became it came under close scrutiny. Somewhere or other, we highlighted that your policies are not really as dynamic as the nature of the borrowers. So static policies need to be updated within time, have updated audit, approval, workflows, all the matrices, so that you need to have limited checks on borrower quality. Somewhere also we highlighted that the model rating scale is very, very long, and there is actually no risk discrimination, no granularity, even though you have a very long rating scale. It is actually not, it is no comfort, it is no convenience, and it is not even offering risk discrimination. So we could propose a shorter rating scale. We could actually propose exactly which grades have to be combined together to reduce the grading, to reduce the rating scale, and then have better discriminatory power with more convenient rating scale for the rating officers. One very important insight, or probably a case that I would want to highlight out of all of these on the slides, is PD calibration inconsistencies have been identified in a lot of clients where there is absolutely no or probably very limited interrelations with the macroeconomic variables. And when there is no integration of macroeconomic variable, your PD is actually not being that dynamic, and it is not telling you the correct picture. So your provisions, your capitals, everything goes for a toss. So yeah, some very important insights, that we could actually share with the senior officials, and very happy to know that those have been implemented, resulting in a positive contribution for those organizations.
Yeah, thank you very much, Niharika. These insights definitely demonstrate the model validation is not just about the compliance, it's about the uncovering structural weaknesses, improving governance, as well as enabling the smarter risk strategies. So we'll move to the next slide. Now, as we look ahead, the focus shifts from the compliance-driven validations to strategic model risk management. The future definitely demands agility, transparency, and resilience in both traditional as well as the AI-driven models. Nirika, please summarize the future directions of MRM. Next slide,
Yes,
please.
absolutely, Saurav. So, MRM is the enabler of tomorrow, and with the availability of cloud-hosted MRM platforms, a very important integration between the risk and compliance, availability of external validation services, where we have external experts in the industry who have worked with a lot of different sectors, lot of different model types, lot of different lender types. These type of external validators, they are going to enable how a lender can actually strengthen its MRM structure. And then a lot of focus growing on making the models explainable, because we are using more and more data science in modeling these frameworks. And it is ultimately going to be leading us to having consolidations and partnerships where we want to, onboard certain external, expertise and validators, where we want to take use of their domain experience, just to enhance our own internal MRM structures. So that is the shape of how we are moving ahead.
So with this, we are going to the last and the final poll of the day. Poll on screen, please. So again, just like as the previous incidents, we'll stay on the poll screen for 30 seconds. We'll get to hear from you, and then we'll see the results that will be coming up. So I think for some technical glitch, we are unable to pull the poll on the screen. So we can go to the slides, please. They have a very interesting poll, but some for technical glitch that is not appearing on the screen. Sorry about that. So we'll go to the slides, please. So we'll go to the next slide, slide 23, please. Next slide, please. 23.
Okay, so as we are progressing from risk management to risk intelligence, we are moving to have more proactive risk validations rather than reacting to a regulatory requirement. We are making our systems more proactive in nature. We are also understanding that model risk has a strategic importance, which we've seen through the various business use cases. I mean, various learnings from the business cases where ICRA Analytics could actually deliver a lot of insights which are underlying the model usage practices. And we also need to understand that all of this governance and all of this compliance is actually going to enable us with the innovation bridge, because so many new products are going to come up, use of alternate data for rating borrowers, so many underlying frameworks for developing more and more scorecards. All of that has to be governed and complied with the regulatory expectations. So yes, that is how we see the industry progressing and becoming more proactive.
So, in conclusion, the model risk management has evolved into a strategic capability that supports transparent decision making, responsible innovation, and long term institutional resilience. The message is definitely very clear: move from reactive compliance to proactive intelligence. That's the purpose, that's the hypothesis. Model risk management, when done right, that becomes a strategic lever for resilience and growth. Next slide, please. So with this, we come to the end, and on behalf of Economics Limited, we thank all participants for attending this session. We hope this insights shared today that supports your effort in strengthening the governance, enhancing model performance, and aligning with regulatory expectations. Thank you very much for joining us. We'll just open the forum for some questions.
So we are requesting all the participants to share your questions in the Q&A box, chat box, and we'll wait for a few more minutes. We've got few questions. Would love to hear about your hands-on experience with the business rule engine validation. How have you approached this at the sector level within risk management frameworks and down to the technical code execution layer?
Yeah, actually, that's a good question, Subhashri. Thank you for raising it. So at ICRA Analytics, we very recently worked with the private sector bank, medium private sector bank, and they have deployed certain business rule engines for various retail category portfolio. And we were given the opportunity to validate those business rule engines where an end-to-end validation of the structural soundness, the kind of risk parameters, whether they make any conceptual logic to defining that borrower category. So that was checked thoroughly. The model was also validated by using certain statistical testing, which we've just discussed very thoroughly in this session also. So that was performed, and also a code level execution check. So all these business rule engines, they are code enabled. So if there is any technical error on those code scripts, then that is actually resulting in a failed implementation. So that code level assessment was also performed. And ultimately the model's output was compared to the challenger models, and our detailed observations and recommendations around the structural soundness, code execution, the sector in which the borrower is rated, all of that were provided in a comprehensive validation report.
All right, we've got new questions from someone. So if a model is developed on a prospect base, industry lookalike customers, because of the business is newly launched and the same model through trained on prospect data is now being used on our actual sourcing, the monitoring may reveal significant population drift and weak risk differentiation. So such as flips and the factoring in bad rates. In such cases, how should we as a validation unit proceed to address these issues?
Absolutely. And that's a very valid real world challenge where we are, because there is a certain data limitation, or there is actually a data limitation where we do not have a proper sufficient amount of data required to develop a model. So we identify a close proxy and we develop a rating framework on that close proxy. But then when we are actually using that model on the real time borrowers, there is a drift. Now, how to come out of this situation will be that we need to have more rigorous model monitoring. That if there is a policy or if it's a practice to monitor model performance on a quarterly basis, or let's on an annual basis, for such models where we don't know whether the training of model is not really done on the actual borrower segment, it becomes all the more important to monitor these models' performance on a much reduced frequency, to have more regular monitoring, and to have a proper dashboard to see that is the drift actually increasing or going down. And with every model monitoring run, and the output of the understanding of the stability test, we need to identify the risk factors which we can fine tune so that in the next monitoring we are seeing reduced drift. So eventually, maybe 3-4 monitoring rounds, we will have proper fine tuned risk parameters to accommodate the real borrower behavior and come out of the proxy and then have a more robust model. So that is one way of addressing this challenge.
So we've got the new next questions, which says, what is the internal audit role in MRM?
So the role of internal audit is so basically MRM, or a model risk management, is assessing that model development, when the models were developed, how rigorously and how closely to understand the borrower characteristics those models were developed, whether the outcomes are correct or not. That is model risk management. right? Now, whether the test that we are performing in model risk management, whoever is the approving authority to identify which model has a problem and which model doesn't have a problem, whether we have complete list of inventory, whether we have a complete audit trail to monitor that the model ratings or the approval matrices are well defined, we need we need an additional layer of audit, that gives the actual assurance that the work done by the validator, how accurate or probably how reliable is that. So we need an audit assurance from that perspective.
We've got the next questions. How do you manage model validation for NBFC scorecards where data paucity is widely seen and taxonomy is not very structured?
So yes, wherever we are seeing data representation challenges, there is some, when we actually see the borrower data set, we need to enhance that data set. We need to pass it through certain data quality checks, and then we need to enhance it to be able to have much more identification of a bad event. What exactly we are trying to measure, we have it in a very less quantity, we have it in a very less magnitude. So there are ways in which we will enhance the underlying borrower data, have certain assumptions around that, probably have more rigid lending policies to change the definition of bad, and then see that where we are with respect to model performance.
Okay, the next question has arrived. Which are all these best model validation techniques that would you suggest, and what things should we keep in mind in opting these techniques?
So it is very important to understand that none of these techniques, they work in silos. It doesn't happen like that. If you are validating whether it's a traditional model or it's an ML model, whether it's a scorecard or a wholesale portfolio, I mean, whichever type of model, when we are validating the prescribed algorithms or the prescribed frameworks, they have to all work together, and only then it will give you the correct picture of model performance. And several times we've seen that what the discriminatory test is telling us about the model, it actually gets reinforced through predictive or stability tests. So they all work together. There is no pick and choose. It is not working in a silo. We have to pass the model through all of these tests to see where the model is standing.
Okay, one last questions. I think we're running short of time. So it's almost 5. So how does your model validation approach differentiate from the industry standards?
So when we look at, we will basically, I would be able to speak more about how we are performing model validation. Is we have transitioned from a manual use of validation toolkits to now using more automated toolkits. So where our model validation execution will be turned around in a much quicker time. So definitely that is also more cost effective for both the organizations. And then because we have a automated toolkit and we also have that manual toolkit in the background, we are actually able to perform model validation on both the environments to get that kind of assurance that the observations we are seeing on the models is actually correct, and the interpretations do make sense. So yes, we are trying to be more effective in terms of our deliveries and being more efficient in terms of our deliveries with regards to model validation.
All right. Thank you. I think it's almost 5, so we'll be happy to answer all your questions in the offline. So we encourage all the participants to participate in the survey questionnaire once you leave the screen, and please get in touch with us. So our respective RM will be in touch with you. Thank you for joining us today, and thank you for your time. Thanks on the panelists as well. Thank you. So thank you, everyone.
Thank you very much.
Thank you.
Thanks.